Hello and welcome. Many dream of a future where money works as hard as we do. Investing is the key to unlocking this potential, turning savings into tangible wealth. Whether in stocks, bonds, or property, the goal is to generate a return. This return is the reward for taking a risk, bringing you closer to financial goals. But as investments grow, a crucial question emerges. How much of that growth do you keep? We often focus on gross return, but net return, after costs and taxes, is what truly matters. The difference can be surprising, impacting your financial reality. Understanding net return is essential for achieving financial freedom. It's not just about making money, it's about keeping it. This knowledge is the foundation for smart investing. Let's explore how to maximize what you keep. Every investor has a silent partner, HMRC. Just as you pay tax on job income, you pay tax on investment profits. Ignoring taxes can be costly. Understanding them is smart financial planning. Taxes can significantly impact your returns, turning a great profit into a modest one. Focus on maximizing after-tax returns, as it's what you keep that counts. The UK tax system offers allowances and tax-efficient ways to invest. Use tools like capital gains tax allowance and ISAs to shield returns. We'll demystify investment tax, breaking down how different investments are taxed. Explore tax-free allowances every UK investor should know. Learn to use these tools to your advantage. Protect your hard-earned returns from the taxman. Let's start with the basics. An investment return is the profit you make from your investment. It's the money gained on top of your initial capital. Returns are often expressed as a percentage for easy comparison. Measuring returns tracks progress towards financial goals. Returns can be positive or negative, affecting your wealth. Consider inflation's role. Real return reflects true growth. Total return includes income and market price increases. Calculating this helps make informed decisions. Is the investment performing as expected? Understanding returns is key to investment decisions. This knowledge is the foundation for tax planning. Investment returns come in two main types: income and capital gains. Income is regular cash flow, like rent or dividends. Capital gain is profit from selling an investment for more than you paid. Income is taxed as it arrives. Capital gains are taxed when realized. A single investment can generate both types of return. A buy-to-let property is a classic example. Rent is income, taxed like salary. Selling for profit is a capital gain. Understanding this dual nature is fundamental. Anticipate tax liabilities and plan accordingly. Don't be caught off guard by taxes. Plan for income and capital gains to maximize returns. Knowledge of tax rules is crucial for investors. Understanding returns leads us to tax implications. The net return is the profit after all costs, including tax. The journey from gross to net return involves calculating tax liability. UK tax system offers tax-free allowances for investors. Deduct allowances from gross return to find taxable amount. Apply the correct tax rate based on asset type and income. Higher earners pay higher tax rates on investment profits. Subtract tax bill from gross return to get net return. Understanding this process is liberating. Be an informed investor, not surprised by tax bills. Plan ahead, use allowances, and minimize tax legally. Maximize the wealth you keep. Investing in shares offers two rewards: dividends and capital gains. Dividends are company payments to shareholders taxed as income. A tax-free dividend allowance helps smaller portfolios. Tax rate on dividends depends on your income tax band. Track salary and investment income to understand tax liability. Capital gains occur when selling shares for a profit. A tax-free allowance applies to capital gains each year. Exceeding the allowance means paying capital gains tax. Tax rates on gains depend on your income tax band. Lower rates encourage long-term investment. Understand dividend and capital gains rules to manage tax. Effective tax management is key for shareholders. Bonds are loans you make to governments or companies. The interest you earn is usually taxed as savings income, but most UK taxpayers get a personal savings allowance up to £1,000 tax-free for basic rate taxpayers. If your interest exceeds this, it's taxed at your income tax rate. Most capital gains on bonds are tax-exempt. Investing in UK property can be rewarding, but tax rules are complex. Rental income is taxable, and you must declare it on your self-assessment. Mortgage interest relief is now a tax credit, not a deduction. When selling, capital gains tax applies, and stamp duty adds upfront costs. Many invest in funds, pooling money to buy assets managed by professionals. Tax depends on what the fund holds: dividends from shares, interest from bonds, or capital gains when you sell. Peer-to-peer lending lets you lend directly for interest, taxed as savings income. Always know your return type, dividend, interest, or gain, to understand your tax. The UK government gives you three key tax-free allowances: the personal savings allowance, the dividend allowance, and the capital gains tax annual exempt amount. Use them wisely to shield your profits from tax, because if you don't use them each year, you lose them. The individual savings account, or ISA, is a tax-free wrapper for your investments. Any returns inside an ISA are protected from UK tax. No dividend tax, no income tax, and no capital gains tax. Each tax year you can invest up to £20,000. Use your allowance or lose it. There's no carry forward. By investing through an ISA, your wealth can grow faster, free from tax, year after year. Tax thresholds determine when you start paying tax and at what rate. In the UK, your income falls into bands: basic, higher, and additional rates. Crossing a threshold can mean paying more tax on your earnings or investments. Knowing where your income sits helps you plan and avoid paying more tax than necessary. Good records are your best friend for tax planning. Without organised paperwork, you're flying blind, unable to track gains, income, or prove your allowances to HMRC. Keep every contract note, dividend statement, and interest record. With a tidy file, you'll have clarity, control, and confidence, making tax time stress-free. Poor record keeping can lead to paying the wrong tax, stressful HMRC investigations, and hefty penalties. HMRC can charge interest and penalties up to 100% if errors are found. Keeping organised records protects you, saves time, and gives peace of mind. Throughout our journey, we've seen that investing is about much more than simply picking the right assets or chasing the biggest returns. The silent but powerful role of tax is something every investor in the UK must face, and it can quietly erode even the most impressive gains if left unchecked. Taxes on investment income and capital gains are not merely administrative details. They are decisive factors in determining the real, spendable profit you keep at the end of the day. For those dreaming of building lasting wealth, the lesson is clear. Understanding tax is just as important as understanding the markets themselves. It's easy to get caught up in headline figures, those percentage returns that look so attractive on paper. But as we've uncovered, the true story lies in what remains after HMRC has taken its share. For some, this might mean losing a fifth, a quarter, or even more of their hard-earned profits to the taxman if they don't make use of allowances and tax-efficient accounts. This is not just a matter of numbers, but a matter of strategy. By learning how tax interacts with your investments, you are empowered to make smarter choices, whether that's timing the sale of an asset, choosing where to hold your investments, or making full use of your annual allowances. The difference between gross and net returns can be the difference between achieving your financial goals and falling short. It can affect the size of your retirement pot, the deposit for your first home, or even the legacy you leave for your loved ones. Taxes may be inevitable, but paying more than you need to is not. The government provides a range of allowances and tax shelters, like ISAs, for a reason, to encourage long-term saving and investment. By planning ahead and being proactive, you can ensure that more of your hard-earned money stays where it belongs, with you and your family. In the end, tax should not be seen as a barrier to investing, but as a factor to be managed. Just as any good investor diversifies their portfolio to manage risk, they should also diversify their strategies to reduce their tax bill. The most successful investors are those who treat tax planning as an integral part of their overall approach, never an afterthought. With a little knowledge and organization, you can tilt the odds in your favor and watch your investments grow, not just on paper, but where it counts the most, in your own bank account. The world of investing is always evolving. Tax rules change from year to year, allowances are adjusted, and new investment products appear on the market. This means that staying informed is not a one-off task, but an ongoing process. Savvy investors treat regular financial checkups as they would a visit to the doctor, an essential part of keeping their financial health in top shape. Whether it's reviewing your portfolio, updating your records, or reading up on the latest updates from HMRC, these small habits can make a world of difference when it comes to maximizing your wealth. Record keeping, as we have discussed, is your shield and your sword. By maintaining clear, accurate records of all your investments, what you bought, when you sold, the income you received, and all associated paperwork, you protect yourself against costly mistakes and unexpected tax bills. Should HMRC ever come knocking, you'll have everything you need right at your fingertips. More importantly, good records put you in control, allowing you to spot opportunities to use allowances, time your transactions, or rebalance your portfolio in the most tax-efficient way possible. Ultimately, the best defense against losing returns to tax is education and preparation. Make use of resources, many of which are freely available online or through your investment platform. And don't be afraid to seek professional advice if your situation becomes complex. Tax planning doesn't have to be daunting. With a bit of curiosity and discipline, you can turn it into a positive, rewarding part of your investment journey. Remember, every pound saved on tax is a pound you can put to work for your future. So, as you look forward to growing your investments, take a moment to look back at what you've learned here. Taxes can indeed make or break your investment returns, but with awareness, planning, and a dash of organization, you will always be one step ahead. Invest wisely, track carefully, and keep learning. The future and your wealth are in your hands. Thank you for joining me, and here's to keeping more of what you earn.